Audio recording for this meeting has begun.
Good afternoon, everyone. Thank you for joining today's webinar, USDA Section 502 Loan Program Updates, USDA Handbook 1-3550, Updates from 2017 to 2019. My name is Stephanie Nichols with the Housing Assistance Council, and I will be the host and moderator for today's call. If you've not already done so, please ensure you have access to both the audio and the video portion of the webinar. To access the PowerPoint for today's call, please follow the link on your meeting confirmation. All participants are in listen-only mode, which means your line is muted. However, we're very interested in your questions and feedback. To submit a comment or a question, please use the chat box located in the lower right-hand side of your screen. We will answer as many questions as time permits at the end of today's presentation. Today's presentation is being recorded. Both the recording and the presentation will be on HAC's website, www.ruralhome.org. We have quite a few participants on the call today, many familiar with HAC, but for those of you who aren't familiar with HAC, I just want to let you know that HAC is a national nonprofit organization based in Washington, D.C. We seek to strengthen rural communities across America through investment and assistance with affordable housing and community and economic development activities that advance rural prosperity. With the mission to improve housing conditions for the rural poor, HAC places an emphasis on striving the poorest of the poor in the most rural places. If you're interested in learning more about HAC services or products, or if you have a question or require assistance, please contact us directly by phone or email. The contact information is currently displayed on your screen, or you can visit us at ruralhome.org. I also want to just let you know of two events to mark your calendars for. We have a rural housing and services for a rural veteran symposium in Jonesboro, Arkansas, coming up in about 3 weeks. And then we have a full Section 502 packaging training for nonprofit developers in Kansas City, Missouri on May 7th through the 9th, 2019. You can learn more information and register for those courses by visiting HAC's website. Today's webinar will provide information on revisions to the handbook for USDA Section 502 Loan Program HB 1-3550. We will discuss changes implemented during FY 2017 and 2018. Most changes relate to the determination and documentation of applicant assets, income, and credit history. Today's experts are Mike Feinberg and Jeremy Anderson. Michael Feinberg is a senior policy analyst within the Research and Information Division at the Housing Assistance Council. In this capacity, he conducts research and develops various HAC information products. He also reviews and prepares technical and analytical information on proposed federal regulations and legislation related to housing conditions and the needs of low-income rural residents. Before joining HAC, Mike was a branch chief in the Single-Family Housing Direct Loan Division, where he provided leadership for the management of USDA Section 502 Direct Loan Program, a program providing about $1.1 billion in mortgages for low and very low-income rural families each year. He's a graduate of Penn State with a bachelor's degree in agricultural economics and rural sociology. We're also joined by Jeremy Anderson. Jeremy began working at USDA Rural Development in 2001 in the single-family housing program in Washington State. His career path has mostly anchored him in the West, having worked in Washington, Oregon, Montana, and Colorado. But that changed when he began working for USDA's RD national headquarters in D.C. He's been part of the packaging program and pilot since its inception, and loves the opportunity to help those who are trying to give a hand to rural communities. Mike, Jeremy, I'll hand it over to you.
Okay, thank you, Stephanie. We appreciate it. Hello, welcome to today's webinar. I'm Mike Feinberg, and as Stephanie mentioned, we also have Jeremy Anderson from USDA with us today. Jeremy just got through a bout with the flu, so we are going to save his voice to answer the questions at the end of the session. So you'll be stuck with my droning voice for now. That's me, that's Jeremy, and this is the session. So in today's webinar, we're going to discuss changes to USDA's handbook for the Section 502 direct program. This is not a general program overview. Rather, it's intended as an update for those who have taken the Certified Loan Application Packaging course more than a year or so ago. As such, the presentation assumes a familiarity with the Section 502 direct program and the handbook requirements. Many of the changes we're going to talk about today are intended to clarify existing program provisions and may not represent significant program changes. The first section deals with becoming a certified loan application packager. As a review, to become a certified loan application packager, one must work for a qualified employer. The qualified employer is an affordable housing organization, whether it be a nonprofit, a public agency, a tribal housing authority, or a state housing finance agency. Generally, persons wishing to become certified loan application packagers work through an agency-approved intermediary. So the next step would be to contact the intermediary where you wish to package loans. And finally, you would take a loan application course such as the ones offered by HAC, NeighborWorks, or RCAC. This slide shows rural development forms and focuses on rural development's forms and resources tab, which may be found at the website I'm pointing to right here. You'll note that there are 3 different tabs. There's a Program 101 tab, which basically gives an overview of the program and a question and answer form. There is a Forms and Resources tab and a tab for the interest rates, which, by the way, is currently 3.5%. If you click on the Forms and Resources tab, you'll be taken to this page. This page provides resources for loan applicants. There's an orientation video, an orientation guide, and some other things, state office contacts. There's information for existing borrowers once someone obtains a loan. This is information on working with our USDA's Customer Service Center. And then there is a section on trainings, webinars, and other handouts. Those trainings include a program overview, pre-qualification webinar, and a handout. There is a guide for determining annual adjusted income. There is this worksheet for computing income is the calculator. If you've taken the packaging training more than 2 years ago, you would have worked with an entirely different income calculator. This one is much more sophisticated. We're not going to get into that today, but there is a video on how to use it. So if you are packaging loans and you're not familiar with it, I encourage you strongly to look at that. There's also some training on credit requirements, how to access the e-forms, and then finally there's a section for certified loan application packagers. If you click on the link, which is right here, it will take you to this web page. Excuse me a second. This section also has various trainings and webinars. I'll put in a shameless plug for HAC's upcoming loan application packaging certification training in Kansas City in May. There are trainings that are similar to what is on the Forms and Resources page and some expanded training directed to packagers. And then there are resources. There's a map for locating the intermediaries and what areas they serve, the intermediary memorandum of understanding, and some other information for loan application packaging. One of the more significant revisions focuses on Section 523 self-help providers. Loan applications for individuals participating in USDA's self-help program are typically not covered by the certified loan application packaging. But sometimes a self-help participant decides to switch to a non-self-help house. In that event, the timing of the switch is the focus for whether the packaging fee can be paid for the agency. So if we have a self-help grantee working with an applicant and they decide to switch before the application is submitted to the agency, they switch from self-help to non-self-help, the associated fees that could apply, depending on whether they're working with an intermediary or not, could be $1,750 to $1,500. If the determination is made after the application is submitted, but before eligibility determination, there would be no additional packaging fee that would be considered covered by the grant if you're working with an intermediary. If you're not, fee is permitted up to $1,500. But once eligibility is determined, the working with the loan applicant is considered covered by the Section 523 grant, whether or not they go self-help or non-self-help. The next set of changes is related to applicant income and assets. Rural Development prefers verification of income and assets through documents that are readily available and generated by a third party. These include pay stubs, bank statements, or statements from other institutions, benefit award letters for sources like Social Security, pensions, or other benefits. One of the handbook changes addresses the dependent deduction when there is shared custody of a dependent. The agency removed language regarding shared custody and who could claim a dependent, and now the deduction is applicable for any household member who qualifies as a dependent regardless of custody sharing. Another handbook change addresses grossing up non-taxable income. In order to be grossed up, the non-taxable income must be considered stable and dependable. The key concept for stable and dependable is whether the applicant has a history of receiving stable income and there is a reasonable expectation that the income will continue for at least 2 years. So this is typically based on a 2-year history of receiving income and an expectation that it will continue for 2 years. The non-taxable income meeting this criteria is grossed up by multiplying by 120%. We included an excerpt from the income calculator worksheet on how you would handle this. And again, we're not going into detail on how to work with the worksheet. There is a separate video on that. But if you take the if we have a non-taxable source of income, say it's $100 a month times 12 months, for annual income purposes, we would consider it $1,200. For repayment ability, if it is stable and dependable income, we could gross it up by 20%, to $1,440. The calculator does all that calculation, and then you would select the appropriate box, whether it's annual income, A for annual, or R for repayment. And if you're not familiar with the calculator, there is a video explaining how to use it. There were a couple of clarifications regarding total debt ratios. One is that funds borrowed against a retirement account need not be counted towards the total debt ratio. And the other change dealt with student loan considerations. For student loans that are in repayment plans, whether that repayment plan is a standard repayment plan, an income-based repayment plan, or some other payment plan that reduces payments, you can use, Rural Development will allow use of the actual monthly payment if it's verified by the lender, the loan is in repayment status, The applicant has a reliable credit score of 640 or better. There are no significant delinquencies, and payment shock is not greater than 120%. If all four circumstances are met, we can use the actual current loan payment, even if it's zero, as long as it's in repayment status. Otherwise, Rural Development requires that we use the higher of the payment in the credit report or 1% of the loan balance. Evaluating borrower assets. Borrower assets must be reported for the entire household. For determining annual income, we look at the actual income from retirement and non-retirement assets. So for a retirement asset, just because it earns income, taking interest as an example, does not mean that the interest is counted as income. For considering retirement assets, we would consider amounts withdrawn from the retirement account. So if you have a 401k that earned $1,000 in interest last year, we would not count that as income. But if you drew down $100 per month for 12 months, that would be $1,200 in income for the year. To consider that as repayment income, again, it must be considered stable and dependable. In addition to income considerations, borrower assets are reviewed for possible use towards purchase of the property. Retirement assets are not considered for down payment purposes. Retirement assets are those that are specifically designated by law or employer policy. Assets that are not retirement assets in excess of $15,000 must be used towards purchase of the property. If the applicant is elderly, the amount would be $20,000. The assets over the established limit can be used as a down payment or for other costs that are associated with the property. And Section 4 or Section 2 in Chapter 4 of the Handbook discusses assets in great detail. We move on to credit history. Applicants whose credit reports have at least 2 scores from a credit bureau with at least 2 trade lines that have been open and active for the last 12 months are considered reliable credit scores. Excuse me. Note that there is an unnumbered letter dated February 25th that temporarily addresses, temporarily relaxes the criteria for open and active trade lines. So as long as the applicant has at least 2 credit scores, the scores may be considered reliable. Non-traditional credit scores should only be considered for applicants who have valid credit scores less than 640 or scores that are not considered valid, scores that are based on less than 2 credit reports, 2 credit scores. Alternative credit is not to be used to make the application look better. So we should only use non-traditional credit if the applicant does not meet the 640 or the reliable score test. On non-traditional credit sources, 3 sources of credit history are required. Those 3 sources could be a combination of trade lines from the credit report and non-traditional credit sources. If one of the sources is rent or mortgage verification, we only need 2 sources of credit verification. Sometimes in community property states where we have an instance where we have non-purchasing spouse. They are applying only in the name of one spouse and not the other. Actually, these got a little bit out of order. The debt obligations of the non-purchasing spouse must be considered in the total debt ratio unless excluded by state law. The non-purchasing spouse must provide credit reports from each of the nationwide consumer credit reporting agencies. Hopefully this would be obtained from the annualcreditreport.com website where people can get their own credit reports at no charge. These credit reports are not being used for loan determinations, but we do have to look at whether we need to look at the debt ratio, the total debt. The credit reports cannot be more than 9 months old at the time the loan is closed or the time loan is approved or that it's closed, and under certain circumstances the housing program director can waive the credit report requirement for non-purchasing spouse in community property states. If we're not in a community property state, we don't need to worry. The handbook provides a lot of flexibility on the type of credit report obtained by the loan application packager. If the packager uses credit reports that do not include credit scores, there is a credit history worksheet in the income calculator spreadsheet. The credit history worksheet is typically completed by Rural Development, but it can be helpful for the packager at looking for instances of unacceptable credit. Rural Development is responsible for filling it out, but it can be used as a guide by the loan packager, especially when you don't have credit scores to rely on. So what do we do when we encounter adverse credit? Adverse credit can be considered, adverse credit does not necessarily kill the deal. It just involves additional review. Extenuating circumstances that are beyond the applicant's control and are not likely to recur may be considered. The loan application package should include a letter from the applicant with supporting documentation regarding derogatory credit. The documentation should explain the nature of the event that led to the derogatory credit. There should also be a loan underwriting analysis explaining for the rationale for granting an exception. In this case, we're looking at an application where the packager is asking Rural Development to consider an exception for adverse credit based on the applicant's circumstances. They were in an event that was extenuating circumstances beyond the applicant's control, likely to reoccur, and they would also need to explain how that derogatory credit was rectified. So again, adverse credit does not make an applicant ineligible. However, they must explain what happened, when it happened, what they did to correct it, and the current condition of their credit. It may be appropriate to consider a credit exception when the applicant has blemishes on their rent or mortgage history, when the loan will result in a significant reduction to their shelter cost. An example of this could include utility costs that are drastically reduced based on energy efficiency improvements, and the energy, it was one of the issues that caused the applicant to get behind in their payments was the cost of energy, the cost of heating the home. So if we've got an instance where the applicant had an unacceptable rent or mortgage history, an exception to that could be considered when making the loan would significantly reduce their monthly payment. Significant delinquencies, what are they and how do we consider them for possible exceptions? There are 4 types of significant delinquencies: foreclosure, deed in lieu of foreclosure, a short sale, a mortgage charge-off completed within the last 36 months, a Chapter 7 bankruptcy discharged less than 36 months before the application, a Chapter 13 bankruptcy which was not completed or not paid as agreed in the last 36 months, and agency debts that are debt settled in the last 36 months or being considered for debt settlement. So for reviewing bankruptcy delinquencies, a Chapter 7 bankruptcy discharged less than 36 months prior to the application may be considered if the criteria for a derogatory credit exception was met. Basically, circumstances beyond their control, the circumstances have been removed, and the applicant has recovered from the adverse circumstance. A Chapter 13 bankruptcy may be considered for exception if the debt restructuring plan and the applicant, if the debt restructuring plan was completed and the applicant made all the payments on time as agreed 12 months prior to the loan application. For a mortgage delinquency, a foreclosure, a deed in lieu of foreclosure, etc., an exception may be considered if the applicant has been released of liability and is not responsible for any deficiency judgment. Again, if the delinquency was due to extenuating circumstances, more than 12 months have elapsed, the applicant has demonstrated ability and willingness to meet obligations when due for the 12 months before the application, and the circumstances are circumstances leading to the delinquency are documented and justified. Significant delinquencies for agency debt. There is no guidance in the handbook for exceptions for this particular significant delinquency. Submitting the loan application package. Typically, the loan application package is submitted through the intermediary unless you're in a circumstance where you've got an exception to work without an intermediary. One of the new things here is the application submittal cover letter. Certified loan packagers submit loan applications with the cover on the qualified employer's letterhead, and that must include the following attachments. Attachment 3J, which is a form, an agency form in the handbook, a checklist of items to accompany the uniform residential loan application, the income calculation and maximum loan calculator worksheets, which you would find on the Forms and Resources website, a copy of the credit report and a preliminary analysis, and you would check the boxes appropriate, whether the score is a valid score of 640 or better. It's the score that was not valid or less than 640. If we obtained a landlord verification and the applicant's explanation of derogatory credit. Derogatory credit. Each applicant must provide a written explanation for late payments, collections, judgments, or other derogatory items in their credit history that they are aware of. Continuing on, attachments to the application submittal cover letter. The packager would prepare a loan application narrative and a signed copy of the required disclosure letter. This is the letter that notifies the applicant that you're a loan packager working through the certified packaging program. We talked about this a bit in one of the other slides. Rural Development does not ask packagers to obtain a specific type of credit report. So if the packager is working with a credit report that does not include credit scores, you would evaluate based on the information available and using the indicators of unacceptable credit as we discussed. One of the attachments to the to the cover letter. The loan submittal cover letter is attachment 3J. That is a checklist of items that accompany the uniform residential loan application packages. For each applicant, we need a copy of their last 2 federal tax returns with all of the attachments, the W-2s, the 1099s, and any other form that is attached to the tax return. If the return was mailed to the IRS, Rural Development wants a copy of the signed document. If it was filed electronically, Rural Development needs a copy of the signature page with the self-select PIN and a confirmation that the return was accepted or evidence that it was provided by an authorized e-file provider. The application must also include the credit report fee. The credit report must be paid. The fee must be paid. This is Rural Development's credit report. It must be paid for by check or money order. Even though the uniform residential loan application form has a section in it that indicates that some income need not be reported to qualify for credit, for Rural Development credit, alimony, child support, all income must be supported. Assets must be verified for the entire household, not just the loan applicant and co-applicant. And we need evidence of a valid taxpayer ID, a Social Security card, a pay stub that has their full ID, or some other documentation. Oops, I went backwards. So what else needs to be considered? First-time home buyers should complete homeowner education training as early in the application process as possible, since the training will prepare them for shopping, buying, financing, and owning a home. First-time home buyers must be informed that when Rural Development issues a certificate of eligibility, they agree to provide documentation that the homeowner education was completed prior to entering into a contract to purchase or build a home. Very low income applicant, other credit. One of the requirements for qualifying for a Rural Development loan is that the applicant cannot get credit from other sources at rates and terms they can reasonably repay. Very low income applicants are presumed not to qualify for private credit. Low income applicants with good credit history and an apparent lack of need for payment assistance should be asked to attempt to obtain other credit before submitting the application to Rural Development. And finally, homes that are financed must be located in an eligible rural area. They have to be on a modest site with safe drinking water, suitable sewage disposal. The value of the site should not exceed 30% of the as-improved market value. The property must not include an in-ground swimming pool, farm service buildings, or income-producing structures or land. Modest dwellings do not exceed the market value, does not exceed the area loan limit, and generally does not exceed 2,000 square feet of living space. And one of the wording changes, recent wording changes, is that streets must have an all-weather surface and be maintained by a public body or a homeowners association. And with that, we can open this up for questions. Or Jeremy, do you want to, I don't see any questions in the box. Do you want to add anything?
I have just a couple notes, Mike. Hi, everybody. There's when you were pointing out the website, this is just something that I noticed today. If your screen isn't maximized, some of those tabs you won't be able to see. So if you happen to go to our web page and you're looking for the forms and resources or the publications or whatever, and you don't see those tabs, just try and remember to maximize your browser window, and then they'll appear. One of the things I wanted to mention on the related to assets is that there was some additional language. Certainly Chapter 4 has a discussion on assets, but in Chapter 6 there was a little bit of a revision that was done on what we call eligible use of assets. And so Chapter 6.2 paragraph B goes into a little bit more detail about if, for example, an applicant does have over that $15,000 or that $20,000 limit, what does the agency permit them to use that money for, other than a down payment? So it could be used for the down payment, but if they are needing to, for example, they want to pay off a car, make themselves more home ownership payment ready, if they had some moving expenses, that temporary shelter costs, like they had to move into an apartment while they moved out of a house, those types of things. I mentioned paying down debt. If they actually were saving and having some retirement accounts, we would allow them to use that excess assets to fund their retirement account. Or make other purchases that are not considered a retirement asset. Excuse me. Again, that's in Chapter 6, Section 2, Paragraph B. So that's relatively new, probably since many of you have had the class. The temporary authorization regarding credit reports, just the plan is that is going to be for the rest of this fiscal year. We are looking at making upcoming changes more permanent that are going to address this. So the whole process that trips a lot of specialists and loan packagers and intermediaries maybe up is, looking at the 24 months of recent, having two accounts that have been open and active for 12 of the last 24 months. That part's been set aside for now. So if they have two credit scores at 640 or higher, that is now good enough for the streamlined credit, evaluation. We're looking at, like I said, making that something like that, or that to become a more permanent change. And then lastly, maybe, Mike, I wanted to mention, on regarding student loans, that's also kind of a temporary authorization. It used to require more stringent or a higher level of authority to waive that. In order to use the lower payments, we've now relaxed or allowed the state offices, the state directors, to grant exceptions on the student loan debts based on each of the criteria. Like, for example, if their credit score was below 640, we could grant an exception on that. So, just that's an unnumbered letter. I think Mike pointed out in his discussion. It's on our website. It came out in February 25th. You'd find it under the publications, regulations, and guidance, unnumbered letters. I think it's just a short 2-page UL for more discussion on that. And I think that's, Mike, that is what I kind of have pulled aside when I was listening to you going through the slides. So there are some questions now. We can take a stab at those.
Yeah, thanks, Jeremy. First one is will we be emailing out a copy of the PowerPoint with the points we covered? The presentation will be up on the HAC website. Stephanie, if you're still on, do you know about when that might be?
Normally, we'll try and get it up by the end of the week. It could be maybe Monday at the latest.
Okay. Okay, so it will be on the HAC website within the next few days. Jeremy, the next question is, if the non-agency debt is paid off less than a year or more than a year prior to application submission, is it no longer considered a significant delinquency? Jeremy?
Sorry, Mike, I put my phone back on mute. The non-agency debt's paid off over a year prior to the application submission. So let's, maybe they had a credit card charged off, right? Is it no longer considered a significant delinquency? So it's definitely an indicator of unacceptable credit. However, if the score was over 640, it would still qualify for streamlined. If it was less than 640, it'd be an indicator. We'd need them to tell us, hey, these are what the circumstances were. Temporary event, unlikely to recur. Situation has been removed, credit's been stabilized, whatever that explanation is. And the key thing is, it shouldn't just be a letter of explanation. It should always include something that helps document what those circumstances were.
And remember that significant delinquencies are foreclosures, deed in lieu, bankruptcy less than 36 months ago, Chapter 6, Chapter 13, which was not completed or paid 36 months ago, or agency debts settled within the last 36 months that are being considered for debt settlement. Okay. Working with the potential applicant in pre-purchase counseling, how do we compute the subsidy they would be getting to make their payment affordable?
So that would be in that forms and resources web page, where the income calculator worksheet and maximum loan calculator worksheet are housed. I think, Mike, you're going backwards to find that.
Yeah.
And you've got control of the arrow there.
Yeah.
So again, remember that link is there that pulls up the spreadsheet, the calculator, and the video is there. The maximum loan payment that describes the subsidy and shows what their how much they'd qualify would be on that second page or the second tab of that worksheet.
Yeah, right here.
Yep.
Okay. Okay, I think this question must have come in just before we answered it. A copy of the presentation will be available on the HAC website in the next few days. Okay, somebody answered the question about using the maximum loan calculator. Income banding, is it going to be approved, and if so, when?
Okay, so it has been gone through rulemaking. It is not finalized yet. Finalizing is still anticipated to be in about another 60 days or so. It would, if it reaches that hurdle, it would be in effect 30 days afterwards. It is it's the end of March right now. Please don't hold us to this. I think when we're making plans, we are thinking that this is going to be likely in mid-summer or early summer. Depending on if you think of summer as starting in June or July.
Okay. Are housing choice vouchers to be grossed up or implemented in the public assistance category on the loan calculator?
And so the housing choice vouchers are specifically talked about in the handbook, and I am just seeing if I can pull it up real quick. Yeah, so under 4.3b. And the housing choice voucher is also listed in that calculator worksheet. Is it to be grossed up? I believe the answer to that is yes. I'm going to look into this a little bit more, maybe if while these questions are going on in the background. I may circle back to this.
Okay. The next question, I realize this information is for someone that's already taken the packaging program. My company has, but not me specifically. Am I allowed to access the RD packaging handbook, handbook 1, 3550? Yes, the handbook is on a public website. It is available on the USDA Rural Development website. So if you go to that site, it's publicly available to anybody.
That's the last one right now? Do we want to give a few more
questions?
Do we want to give a few more
moments? Anybody else have
here?
any questions? Or we can definitely, I guess we could open it up for voice questions.
Okay, I'm going to go ahead and turn off lecture only mode. Aware that if you have background conversations or music on hold or anything like that, everyone will be able to hear it.
Okay, any other questions?
Mike, I'm going to add in, so for Anna, who asked the question about housing choice vouchers, I'm going, if you can send me an email directly, because there's a couple of things that I may want to ask you more about. Whether or not the payments are being given to the applicant, whether or not there's a separate savings account, and so that can impact whether or not the whole thing is grossed up. It should not be grossed up, but I would like to talk to you a little bit more about what the circumstances are. They're run a little bit differently depending on the program and the local housing authority.
Okay.
Any last minute questions? Oh, sorry, Mike.
I was going to say one last call for questions. I guess you made it.
I wanted to remind everybody that you'll be getting an evaluation form later on. I appreciate it if you would give us your feedback at direct our future webinars. And like we said earlier, please keep a lookout for the recording of today's session, the PowerPoint, all that good stuff that will be posted on the HEC website in the next few days. Thank you so much to our presenters today. I think we had a great conversation, and I wish everybody a great day.
Thank you. Thank you for participating with us.
Thank you, Mike, for taking over from my voice.
No problem.
Thank you, everyone. Thanks. Bye.